The U.S. economy is in a good place, and we will continue to use our monetary policy tools to help keep it there. The jobs market is strong, showing healthier wage gains and prompting many people to join or remain in the workforce. The unemployment rate is near historic lows, and inflation remains near our 2% goal. We continue to expect that the American economy will grow at a solid pace in 2019, although likely slower than the very strong pace of 2018. We believe that our current policy stance is appropriate. Since last year, however, we've noted some developments at home and around the world that bear close attention. Given the overall favorable conditions in our economy, my colleagues and I will be patient in assessing what, if any, changes in the stance of policy may be needed. Let me explain in more detail how incoming data warrant our current stance and a wait-and-see approach to changes. With the benefit of fiscal stimulus and other tailwinds, growth in 2018 was strong, in fact at 3.1%, the strongest year in more than a decade. For some time, most forecasts have called for growth to continue in 2019 at a somewhat lower but still healthy pace. For example, last September, committee participants saw growth coming in at about 2.5% this year. Data arriving since September suggests that growth is slowing somewhat more than expected. Financial conditions tightened considerably over the fourth quarter. While conditions have eased since then, they remain less supportive of growth than during most of 2018. Growth has slowed in some foreign economies, notably in Europe and China. While the U.S. economy showed little evidence of slowdown through the end of 2018, the limited data we have so far this year have been somewhat more mixed. Unusually strong payroll job growth in January was followed by little growth at all in February. Smoothing through these variations, average monthly job growth appears to have stepped down from last year's strong pace, but job gains remain well above the pace necessary to provide jobs for new labor force entrants. Many other labor market indicators continue to show strength. Weak retail sales data for December bounced back considerably in January, but on balance seemed to point to somewhat slower growth in consumer spending. Business fixed investment also appears to be growing at a slower pace than last year. Inflation has been muted, and some indicators of longer-term inflation expectations remain at the low end of their ranges in recent years. Along with these developments, unresolved policy issues such as Brexit and the ongoing trade negotiations pose some risks to the outlook.